So in this instance, we buy two NVIDIA to open, 700 strike calls now. So we've gone up quite a bit as far as our call strike is concerned. We've gone out in time, took some money off the table, put the value back to $64,200. But now the portfolio, because it's not just NVIDIA, but the portfolio went from 200,000 in that time frame up to 330,000. Market value of the position now is 64,000, back to about 20% of the total portfolio value. In our world, that's probably going to be coming back to about 10%. All right, next, let's see what happened. So here's the purchases and here's the sales. On 10/18, we made a purchase of $15,500. On 12/11/23, we made a purchase of $35,610. That means a total purchase of $51,116. Ultimately, that was about 25% of the portfolio. And then we came out and we had a couple of sales. We sold one option contract, brought in $38,000, and then we rolled some option contracts and brought in $119,000 on that roll. Net credit of $157,280. Okay, don't spend too much time looking at the numbers. Like I said, I feel guilty sometimes talking about this one trade because it obviously outperformed the market, but it's more so about the maintaining of that position. So if we look at the sales, we still want to be in NVIDIA. So with that capital that we brought in, we paid 51 grand, we brought in 157 grand, we have 106,000 net credit. We're still going to make a new purchase. So we go all the way back to the 64,000, we bring the portfolio back down to that allocation that we wanted, right around 20% at this point in time when I was managing this portfolio. And boom, now we have a new position. We're long 2 NVIDIA, June 6, 2025, 700 calls at $321. Our delta goes back to 80, 450 days to expiration. Turns out that that's 19% of the portfolio. And right now, just on that NVIDIA position, we had a $41,000 gain, which is the difference between, I'm going to jump back one more slide, difference between that and the new purchase. And that ends up with 41,000. And we still have the 2 option contracts. And as long as our outlook on NVIDIA hasn't changed, you would still be in that position looking at that trade. But that's the outlook on the way up. Now, I'm not going to take the time to go through an example on the way down, but here's what's up. If we do have stocks that are going down and our outlook on the underlying changes, there are 2 simple rules to me. And I'm going to use this example here to try to just kind of talk about it. I talked about how we pick up deltas on the upside, and that's a wonderful thing about deep in the money calls. As the stock goes up, you gain more and more shares of stock because you gain more and more deltas. Well, as the stock goes down, you lose shares of stock. In other words, it doesn't go down as hard as it does on the way up. So if an option contract eventually becomes an at-the-money option contract, guess what delta becomes? It goes from 80 down to about 50. So you lose less the downside. Now you still got time decay, right? You still got theta, you still got issues that you got to deal with in an options price that you don't have to deal with the stock. But if the stock ever comes down to the 700 strike, we're going to get out. First of all, our forecast has probably changed, and you're going to be selling an at-the-money option contract. You'll be selling the juice of that at-the-money option contract. We're going to add in some other things to go along with this, though. Like, we'll be concentrating on price. We'll be looking at the chart of the underlying. We'll be looking at the fundamentals of the company. Somebody brought up the fact that in a 6-month time period, there's going to be a couple of earnings reports. We're going to be aware of that, without a doubt. So that will affect what we do with our positions, but I never want the stock to go below that strike. I want the benefit of selling an at-the-money option contract and getting all that time premium on the downside. So that's some of the protectionism that's going to be inside this trade. And just by itself, you know, the fact that you are paying less than buying the stock outright. And we're going to come up with a leverage model as to how many option contracts that we want to trade relative to buying 100 shares of stock. But that's it. That's basically where we go.